In this video, we're going to be focusing on the top 5 mistakes that new options traders make and how to avoid them so you don't end up like this.
I declare bankruptcy!
Mistake number 1, not expecting to lose money. Let's get this one out of the way right off the bat. You are 100% going to lose money as an options trader. I have yet to meet a trader who has gone perfect on every single one of their trades and become a filthy rich millionaire. It just does not happen without you losing money along the way. Back when I started trading in 2019, I paid $5,000 for a professionally led trading course. I read multiple books. I listened to all the podcasts, watched videos, much like yourself, and I still messed it up. Meaning, the only thing that I can say with 100% certainty is that if you are a trader, you will lose money at some point. The quicker you can break through this psychological barrier, the better off you're going to be. And once you end up losing those first dollars, just accept it as part of the phase of a beginner learning how to trade options. Also, it's better to start with a small amount so that when you do ultimately mess it up, it's not as much of a deal breaker as if your account was fully maxed out. For example, if you start trading with $5,000 to $10,000 in your account and you make a 10% mistake, the loss is only $500 to $1,000. Instead of going in with a $500,000 account or $1 million and then losing 50 or 100 grand. Mistake number 2, ignoring time decay, aka Theta. Now, the way most people start with their options trading career is by buying call options. Why? Well, because they're simple to understand and simple to execute. If you buy a call option and the price of the underlying stock goes up, you're going to make money. However, what tends to happen is that people buy all their call options at the beginning with very, very short expiration dates. I'm talking 0 day, 1 day, 3 day, 5 day, which means it's super tempting to pay $100. And if the stock getting pumped by your online Discord server goes up by 200%, you're rich. That's very tempting, I understand. But the thinking is absolutely flawed. So what ends up happening, all these short dated options, they're so close to expiration, they're actually garbage for your new option traders, especially as call option buyers. That's because as time ticks on, Theta is actually devaluing the call option that you've got your whole account riding on. With these short time frames for expiration, the contract actually works against you in that there's not enough time for the stock to move like you need it to. And even if it moves upwards a little bit, you're still going to likely end up losing the trade because time decay is just moving so much quicker in the opposite direction, dragging your contract price down to 0. Instead, what you could be doing is understanding how time decay works and use it more in your favor. If you're selling option contracts, you actually get paid to harness that time decay. Or if you do want to go ahead and still buy contracts, puts, or calls, make sure you're going out far enough in time. I like to target around the 30-day plus mark for these types of contracts so that your profits aren't getting chopped down by Theta and your trade actually has some time to work in your favor. Mistake number 3, not understanding how options work. Now, you may not think this is a problem, but it absolutely is. I see so many comments, so many emails, so many questions just with the basics, fundamentals of how option contracts work. If you don't understand and you're just like everybody else jumping into options trading without fully getting the big picture, it's not going to go well. You may see a guy on YouTube promising easy money, but options are harder to learn than regular stocks, and every trader comes into options with a lack of understanding or knowledge at the beginning. You've got to take your lessons, get those reps in, lose that money as we've talked about here. And if you don't know what calls, puts, strikes, expiration, delta, gamma, vega, rho are, then you likely shouldn't be trading options at this time. Or if you are doing it, please keep your account size and your trades to a minimum. In all likelihood, you're probably going to get frustrated when you lose money, when you don't understand what you're doing, and that could deter you from being an actually pretty good options trader if you don't know the basics from the start. Instead, what I would say to focus on is understanding those basic terminologies and how the basic fundamentals of options trades work. Look for a beginner-friendly strategy as well, like selling covered calls, and definitely paper trade with fake money in a fake trading account to get your reps in to feel more comfortable at the beginning. If you want a step-by-step walkthrough to get you up to speed on the basics, check out my Options Academy course currently offered at a 50% discount. You can check it out in the link in the description of this video or right there. Mistake number 4, revenge trading. Let's say you make a trade and you lose. You see the market shift and think, I got the first one wrong, but I can make it all back. This is the one I'm going to get it all back on, and I'm going to go in deep on the second trade. Well, that's when you jump in without any kind of technical analysis. The fundamentals of your original trade have changed, and you just say, F it, I'm doing it, I'm going to get it back, and that's when you lose even more. Again, the fundamentals of your original trade are gone, they're poof, they're history, and you start trading on hope and with emotion. And this is never a good strategy. The market punishes those who rely on hope. And what I want you to remember is that you plan out your trade in advance. You set your why, you have sound reasoning, you have your planned entry and exits. And in case you have to kind of parachute out of the deal, you hopefully have a stop loss or a stop loss target to get out with. All of that can't just go out the window. So when you're losing trades, it's better to take a step away from the desk, even shut down your trading platform for the day, come back to it the next day with fresh eyes, with no emotional investment, and go back to your strategy, go back to your planning, and make sure you're executing on a fundamentally thought out process. Mistake number 5 is ignoring implied volatility. Implied volatility, or IV, in most trading platforms plays a significant role in options trading, especially when it comes to the option contract pricing. Many traders don't even really understand what IV is, so they don't understand when they're buying overpriced options or selling undervalued options and not getting enough return on the risk that they are taking. Much like Theta Decay that we talked about in mistake number 2, implied volatility can chew up your profits in a trade real quick. Here's an example with a call option. Let's say a company is reporting earnings and you buy a call option in and around that earning report date. If the earnings come out positive and the stock moves upward a little bit after hours, that's great because you're likely going to make some cash with your call option that you purchased. However, because all the risk and uncertainty around that earning report is now gone, the volatility in that stock and the market is going to drop drastically, or what's known as volatility crush. And it's this crush, or sucking the volatility and sucking the uncertainty out of the trade and the market, that's going to lead you likely to lose that trade, even though the stock went in the direction that you wanted it to. Options pricing are based on time, on price, and on volatility. So when the volatility goes bye-bye, it can substantially affect options pricing, which is why you need to understand how implied volatility works. And general rules for dealing with volatility in a positive way. If you are an options trader who wants to buy options, you want to buy when volatility is low. And if you are selling option contracts, you want to sell when volatility is higher. Buy low, sell high, just like in overall kind of stock trading, but just use this as a guide when it comes to trading with your volatility index. By avoiding these mistakes, you can improve your chances of success and reduce unnecessary risk when trading options. If you're like most traders, you probably use TradingView for your technical analysis and your chart reading. If you want to watch and learn how to optimize and set up TradingView for an options trading strategy, talking charts, scanners, watch lists, screeners, the whole bit, check this video out right here.